Did you know that your bank is secretly making you poorer? Yes. That safe haven where you stash your hard-earned money could be the very thing holding you back from financial prosperity. In today's video, we're going to shatter a common myth that's been ingrained in our minds for generations. A myth that's preventing millions of hardworking individuals like you from achieving their financial potential. Before we get started, if you're new here, make sure you subscribe and hit that bell icon so you don't miss out on our next videos. The illusion of savings. Meet John, a hardworking middle-class individual who receives his paycheck at the end of the month. After paying his bills and setting aside some money for groceries and other necessities, he puts the rest of his money into his savings account. He does this month after month, year after year, believing that he's doing the right thing. After all, isn't that what we've all been taught? Save your money and you'll be set for the future. But what if we told you that John, like many others, is caught in the illusion of savings? Most of us grew up hearing that saving money in the bank is the safest and wisest choice, especially among the middle class. It's a belief that's been passed down from generation to generation. Your grandparents did it, your parents did it, and now you are expected to do the same. But have you ever stopped to question why? Firstly, of course, there's the allure of security. When your money is in the bank, it feels safe. It's protected from theft, and it's not going to suddenly disappear. Plus, with insurance schemes like the FDIC in the US, even if the bank fails, your money is still secure. This sense of security is comforting, and it's one of the main reasons why people choose to save their money in the bank. There's also the fear of risk. Investing is dangerous. The stock market goes up and down. Real estate markets can crash. Your business will fail. You might hear this. Compared to the volatility of investing, saving money in the bank seems like the less risky option. Why gamble with your hard-earned money when you can keep it safe in the bank, right? Interestingly, there's also a factor of financial literacy. Many people simply don't understand how investing works or what stocks are. They don't understand the concept of compound interest, and because they don't understand these things, they stick to what they know: saving money in the bank. While we're at it, let's talk about a hidden enemy that's silently eating away at your savings: inflation. In simpler terms, as inflation rises, every dollar you have buys a smaller percentage of a good or service. It's like a stealthy thief, slowly but surely stealing the value of your money. For those you don't know, there are two main types of inflation: demand pull and cost push. Demand pull inflation occurs when demand for goods and services exceeds their supply. It's like a bidding war at an auction. When more people want to buy a limited item, of course, they're willing to pay more for it, driving up the price. On the other hand, cost push inflation happens when the costs of production increase, causing producers to increase prices to maintain their profit margins. Imagine you're a coffee shop owner and the price of coffee beans goes up. To keep your business profitable, you'd have to increase the price of your coffee, right? Let's say you have $1,000 in your savings account and the annual inflation rate is 2%. That means that what you can buy for $1,000 this year will cost you $1,020 next year. In other words, the real value of your money is decreasing. Back in 1980, the average price of a movie ticket in the US was about $2.89. Fast forward to 2024, and the average price has soared to over $11.75. That's a 306% increase. I mean, if you had saved $2.89 in 1980, it wouldn't be enough to buy you a movie ticket in 2024. That's inflation at work. Moving on, there's an interesting economic concept of opportunity cost that refers to the potential benefits an individual, investor, or business misses out on when choosing one alternative over another. In the context of personal finance, it's what you're giving up when you make one financial decision over another. And when it comes to saving versus investing, the opportunity cost can be substantial. Let's go back to our friend John. Remember him? He's been diligently saving his money in the bank, thinking he's doing the right thing. But what is he giving up by not investing that money? First of all, he's missing out on potential growth. The stock market, for example, has historically returned an average of 7% per year after inflation. Real estate investments can also provide significant returns, especially in booming markets. By keeping his money in the bank, John is missing out on these potential returns. Let's not forget about the magic of compounding interest, often described as interest on interest. John has $10,000 in his savings account, earning an annual interest rate of 0.5%. After 20 years, he'll have about $10,500. Not much of an increase, right? But if he had invested that $10,000 in the stock market and earned an average return of 7% per year, he would have over $38,600 after 20 years, thanks to the power of compounding. I mean, that's a whole difference of over $28,600. So, by choosing to save his money in the bank, John is giving up the potential growth and compounding interest he could have earned through investing. That's the opportunity cost of his decision. So, how do we escape this trap of lost potential? Is there a path to wealth? The answer is investing. Just like planting a seed and watching it grow over time, investing is about putting your money to work for you. Instead of letting your money sit idle in a bank account, losing value to inflation, you're using it to generate more income. And you know what? The best part is, you don't need to be a Wall Street whiz or a millionaire to start investing. Yes, forget that misconception that only the wealthy can invest. Today, all you need is a little bit of money, a lot of patience, and the right knowledge. There are so many different ways to invest your money. Stocks, mutual funds, bonds, real estate, and even cryptocurrencies are all viable options. Let's dig into each one a bit more. Take stocks, for example. Buying a stock means buying a piece of a company. If the company does well, the price of the stock goes up, and you make money. But if the company doesn't do well, the price of the stock can really go down, and you can lose money. Despite all the risks, investing in stocks has proven to be one of the most effective ways to build wealth over the long term. As the famous investor Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." According to a report by Goldman Sachs, the average annual return on the S&P 500 index over the last 10 years has been around 13%. Bonds, on the other hand, are a bit like IOUs. When you buy a bond, you're essentially lending money to the issuer of the bond, whether it's a corporation or even a government. In return, the issuer promises to pay you back the money you lent them, plus interest, at a specified date in the future. Bonds are generally considered less risky than stocks, but they also offer lower returns. ETFs are another popular investment option. These funds pool money from many investors to invest in a diversified portfolio of stocks, bonds, or other assets. Plus, point is that they're managed by professional fund managers, which makes them a good option for beginners who may not have the time or knowledge to manage their own investments. Real estate investing involves buying property to generate income, either through rental income or through buying and selling properties for profit. Real estate can provide a steady stream of income and can also appreciate in value over time. However, it requires a significant upfront investment and can be illiquid, meaning it can be hard to sell quickly. Let's move to the digital asset. Cryptocurrencies, like the famous Bitcoin and Ethereum, use cryptography for security. They're a relatively new and highly volatile investment option. While some people have made fortunes investing in cryptocurrencies, others have lost money due to their volatility and the lack of regulation in the crypto market. It's very important for beginners, or anyone who's in the game, to keep in mind, investing isn't just about picking the right stocks or buying the hottest crypto. You have to make informed decisions based on your financial goals, your risk tolerance, and your investment horizon. And that's where financial education comes in. It's a process of learning the skills and knowledge necessary to make better and more effective decisions about managing your money. It's about understanding how money works, how to manage it, how to invest it, and how to protect it. Well, that's it for today. Saving money in the bank might feel safe, but it's just not the best strategy for growing your wealth. If you enjoyed the info in this video, we'd love to hear from you. What are your thoughts on saving versus investing? Have you started your investing journey yet? What challenges have you faced? Share your experiences in comments below. And if there's any topic you'd like us to cover in future videos, let us know that too. Before you go, don't forget to check out our video on escaping the rat race of the middle class. What you need to know. Make sure you hit that subscribe button and press the bell icon. Thanks for watching.